Investing is a multifaceted endeavor. On one end of the spectrum, investing can be straightforward, and on the opposite end, investing can be really complicated. For this blog, we're going to stick with the 4 fundamental concepts. Concept number 1, what's the purpose of the money? This is by far the most important question to ask yourself and discuss with your financial advisor. The answers to this question will drive all subsequent discussions. As a financial advisor, I need to know the answer to this question since it allows me to assist you in building your investment plan. We can help you look at this question from different perspectives and allow you to consider various options as an investor that you might not have considered previously. Is the purpose of this money for retirement income? Is the purpose legacy to future generations? Is the purpose for the down payment on that retirement house in the mountains? When will you need this money back? How will this money be taxed? All these questions connect back to the primary question, what's the purpose of the money? Number 2, what is asset allocation? And why would an investor want to learn about this concept? Historically, asset allocation is spreading out dollars in various asset classes, but what's an asset class? Stocks or equities are an asset class, bonds or fixed income are an asset class, and then there's subclasses to all of these. And that can be really confusing. International growth versus US-based growth, corporate bonds versus municipal bonds. And then we have exchange-traded funds and mutual funds and closed-end funds, and this asset allocation can get really convoluted. The purpose of asset allocation is simple. You spread out dollars because you can never know what asset class is going to perform well each year. Some years bonds outperform stocks, and other years stocks outperform bonds. There are entire books written about this subject, and these do a deep dive into what this asset allocation thing is. For most people, they're better served by just keeping it simple. Concept number 3, investing for income. This is by far the most frequent question I get on a weekly basis. You have worked a long period of time building your retirement accounts, and now it's time to actually retire. How are you going to replace your paycheck? What risks will you need to address during your retirement? How will this income be taxed? Will I be in a lower tax bracket when I retire? The answers to those questions are all taken into account when investing for income. One way I like to describe investing for income is the grand prize game from Bozo's Circus. The goal of the game was to throw a ping pong ball into 6 buckets, various lengths or distances from the starting point. Income planning can be simple. We build buckets of money. Each bucket has a purpose and a timeline for its use in the future. And as you progress through retirement, each new bucket is turned on for income. Over time, all these buckets may have income turned on or not, whatever your specific situation requires. So this investing is custom built just for you. And we can't forget about legacy. We may need to take that into consideration as well. Concept number 4, investing for growth. Investing for growth is way different than investing for income. And by different, I mean the use of different investments, different allocations, different expectations, and different levels of risk of loss you are willing to accept. But the principle of asset allocation remains the same. However, the instruments that we use are going to be way different. For example, investing for growth might use the index of the NASDAQ, or investing for income is going to use a corporate bond. Completely and totally different tools. Once again, it all comes back to what's the purpose of the money. Investing and investing concepts are fundamental to building a retirement income plan. Taking into account the purpose of the money, how to asset allocate, they're all important parts of your overall plan for you and your family.